All right. Hold on, let me just hit record 1 second.
Recording in progress.
All right. Welcome, everyone, to today's Sunday macro wrap up for Sunday, July 27th. We have a pretty busy week this week. Definitely not like last week where it was a little bit quiet in terms of the macro data and, the market kind of grinded up.
You're muted, Johnny.
Oh. Can you guys hear me now?
Yeah, I hear you now.
Perfect. Thank you. Yeah, so like I was saying before, pretty much last week was a little bit more of a quieter week in terms of the macro data, and the market just melted up. We've been getting some positive developments in terms of the tariff situation, and so we'll go ahead and get into some of that as well. But just taking a look at the markets overview, this has been a pretty large record-breaking uptrend that we've been seeing. If you take a look at the percentage of times that we've been above the 20-day moving average, the S&P 500 at the close of last week was above its 20-day moving average for 60 days in a row, which is the longest streak since 1998. And then going back 50 years, this has only happened 4 other times. And so this is a pretty impressive move in terms of the performance that we've been seeing, and something that is definitely an outlier. Now, that doesn't mean that we automatically go bearish on the market, right? It doesn't mean that, things are overbought, we need to just sell everything right now because it's going to have a correction. That's not what we want to do at all, right? We want to make sure that, this might be a good time to take some profits near the top end of the trading range, but ultimately it's raising cash so that we can buy lower on the next dip, because that will definitely eventually happen. Just not sure when or what magnitude, but the recent rally has been pretty impressive here. So also as well, earnings wise, we're going into the heat of earnings season this week with earnings reports from Microsoft, Apple, Amazon, Meta, Visa, MasterCard, ExxonMobil, Chevron, Procter & Gamble, United Health Group. Lots of huge, Mag 7 reports, as well as the big financial players. So, this is one of the busiest weeks it might be the busiest week in terms of earnings season. And so you have that as well as a large, calendar worth of macro data with jobs data from July, right? So we have JOLTS, non-farm payrolls for ADP, non-farm payrolls from the BLS on Friday. We have core PCE, which is the Fed's preferred inflation measure. That's on Thursday. And ISM manufacturing PMI on Friday. The first estimate of Q2 GDP on Wednesday. And then also later that day at 2 p.m., we have the July Fed meeting. So compared to last week, as you can see, where, pretty much all we had was flash manufacturing and services PMI, as well as some housing data that really came in a little bit better than expected. A little bit of a decline from the manufacturing PMI, but a large rebound in the services PMI, which is a positive outlook. Besides that, it really was a quiet week last week, and so now we just have a bombardment of data this week. So, that with kind of the setup that we're seeing, new all-time highs every single day, pretty much last week. And then also too, when you take a look at the volatility index of the S&P 500, this number here is at historic lows, right? So anytime that the VIX is 15 or really like 17 or below, they call it like holding a beach ball underwater. I don't know if you've ever done that at the beach or at the pool, but once you lose control of that beach ball, it flings back up. Not to say that it can't sustain this for a long time or go any lower, but typically Any time below this is extreme, bullishness, which we really, for the majority of the time since the pandemic, have only had that, for possibly a few months. So far in 2025, this has been the lower end of the range for the VIX before it trends higher. So that, as well as something that my team and I also look at, which is the VIX 3-month VIX ratio. Typically, when this ratio is at 0.8, that has been a great time to raise cash because that is typically signaled, peak bullishness. So, there's a lot of signals that are pointing to just an exhaustion in the current uptrend move. But again, that doesn't mean that we go bearish on the market. It just means that we want to make sure that we're not, heading into the slaughter, so to speak, with people who are not keeping track of different trends. So yeah, pretty much that was the only thing that we saw last week. Now, if you guys remember, for the labor market data from last month, we saw how there was still pretty much an unchanged measure of job growth from the non-farm payrolls establishment survey compared to May as well as April of this year. And really, not as much of a large uptrend compared to the last 6 months. But the thing is that when you break that up into private payrolls, which is really the majority of jobs in this country, we saw a large deceleration in private jobs growth, while government jobs growth had a very large acceleration. Now, we'll get into here in a second, like which type of jobs this was in the government. But, the labor market isn't as strong as, what the headlines say. And, ultimately what the Fed, if you guys remember last year, once the Fed started cutting in September, they blamed it a lot on the labor market. And so that's one of the main things that the Fed is going to be tracking. And although it's a severely lagging indicator, it's something where that's pretty much what's going to be the main signal for the Fed to cut rates, if that happens. And so pretty much the job deceleration in the private jobs growth was masked by the increase in government job growth. And then the other measure, which is from the ADP group, that employment change went negative for the first time. I think it was, let me see here. Yeah, that went negative last month for the first time since March of 2023. So we'll see if that trend continues. It's pretty rare that we see it negative for more than 2 months in a row. Pretty much the last time that we saw that was the pandemic. So it'd be quite the signal if this went negative 2 months in a row. But it's highly unlikely. But still, a slowing trend in the ADP employment change is a good indicator for actual private job growth. All right, taking a look at the Fed meeting here this week, there's a 97.4% chance that they're going to remain paused. So the market is pretty much pricing in that they're not going to change their policy rate. But it's really what the market isn't pricing in, which is pretty much any type of commentary that Jerome Powell makes during the press conference, right? And so that's what people typically pay attention to. But they're not going to cut rates this meeting. Taking a look at the September meeting, though, there's a 40% chance that they're going to cut by 25 basis points. But if the current trend continues, where the labor market remains pretty much where it's at, no real substantial changes in the unemployment rate, then there's not really any reason for the Fed to cut rates while the market continues to make all-time highs. Growth is still slowing, but it's kind of stagnant. And then even though inflation is looking like it's ticking up, it's not getting blown out, right? And so either something breaks in the employment market, or we start to see a continued improvement in disinflation back down to the Fed's 2% goal. But even if we saw inflation start to come down again, which it's not, the Fed would still need a couple more prints of it continuing down closer to 2%, right? So it's currently not showing that right now. In fact, if we take a look at the Cleveland Fed's inflation nowcast for PCE, right? So we're getting this week. That's going to come in at 2.66%. As of right now, the year-over-year core PCE, actually, I don't have it up, but let's just take a look here. Let's just go to Fred, PC. Apologies, I didn't have this up before. So headline is 2.3. What do they have headline at here? So they have that rising from 2.3 to 2.5. So that is a pretty meaningful acceleration. And then we'll do core PCE. I think it's this one here. Right now, PCE, core PCE is currently at 2.7%. And then they have it as, I forget. Okay, they have it staying near 2.7%. Specifically, it's, where'd it go? 2.67. So they have it remaining steady where it's at right now. So yeah, no real material change in, inflation in terms of personal consumption expenditures. And they say that they're going to see that remaining even into the August print, which that would be, the July number. So we'll see what happens there. We don't get inflation numbers until, let's see. It's typically the second week. Yeah, so that's not, we don't get CPI for July until August 12th. So we have a couple more weeks until that print there. And so also as well, we have the first estimate of the Q2 GDP number. Right now, the Atlanta Fed GDP Nowcast is pricing that at 2.4%. And so that's a pretty continuous decline from its initial reading, back at the end of May there. And so as we know from the third estimate of Q1, with it being negative 0.5%, which was a slight improvement, I'm sure it'll be positive, but that's something that the market is already pricing in. But overall, I think that which was it? I think it was the conference board's leading economic index that has the year-over-year GDP for the entire year at 1.5%, which is still pretty low, pretty much lower than this, as well as a pretty decent slowing year-over-year from 2024 to 2025. So they still have growth remaining slow and inflation remaining sticky, which is why the Fed is remaining patient. Now, just a little bit of an education with the labor market data that we have for this week. With the payrolls, people get confused because there's technically two jobs numbers that are being shown when it comes to the payroll by the BLS. One is the establishment survey, which is taking information from actual businesses, and there's the household survey, which is taking a survey from individuals. Now, the unemployment rate that we know of, that comes from the household survey, which we'll get into in a second here. But whenever you hear of non-farm payrolls, that's coming from the establishment survey. And so as we can see, this is the all employees total non-farm right here at 159,000. And what I typically like to do is I like to take a look at the percent change from a year ago. And as you can see, it's pretty much, remained flat. It's remained flat pretty much for over 2 years now. So job growth really hasn't improved. And then when we take a look at the private jobs numbers year over year, same thing. I mean, this is, pretty much remained flat for over 2 years now. So even though in the headlines we've been seeing that job growth has remained stagnant, that's really been the trend for the past couple of years. We've just been feeling it more recently. Now, one of the leading indicators that I like to look at is the construction job prints, which that has been decelerating from its peak from June of 2022. So we always have to pay attention to construction jobs. Okay. So one of the things that we were talking about beforehand was the acceleration in government jobs, right? Well, when you take a look and divide that into federal, state, as well as local government jobs, it gives you a little bit of a better picture here, right? So, pretty much over the past, pretty much since May of 2022, we've seen a pretty large acceleration in total number of government employees. When we break that up into federal, that has had an acceleration, but pretty much since January of 2025, when Trump took office, you've seen a pretty sharp decline in federal workers. Let me scroll up here. So as you can see, this dip right here, the real acceleration in government jobs has come from the state level, right? So state level jobs has had an explosion pretty much since January of 2023, as you can see here, going from 5.2K jobs to 5.58. And then same thing with local government, but really it's from state government hiring. And then that's the establishment survey. But what we really care about is both are important, but when taking a look at the household survey, the BLS has a nice little graphic here showing how they characterize the labor market. And this is important here in a second when considering the unemployment rate, because when people see the unemployment rate and they see it come down, they're thinking, okay, the labor market is looking really good, but that's not necessarily the case. The unemployment rate could actually tick down for the wrong reasons, which we'll get into here in a second. And so when taking a look at the entire civilian population, 16 years and older, working age people, you have it divided by the labor force and people not in the labor force. The people in the labor force are then divided up into people who are employed and people who are unemployed, right? So the employed and unemployed both make up the total of the labor force. And then you have the not in the labor force, which are neither employed or unemployed, which we'll dive into that more in detail here in a second. So you have the total civilian labor force, which is 170 million people. You can take a look at the total employment to population ratio. And as you can see, that's pretty much remained flat since March of 2022. A slight decline, but near January of 2016 levels. But you haven't really seen a large increase there. Here's the employment level. You did have a little bit of a spike here in January of 2025. But what's interesting here is, let me see, where is it? Okay, so you have the unemployment level, which did decline over the past month. But a lot of people were saying that was a positive outlook, as the unemployment rate has been declining or had a 1-month decline. But as you can see, the number of people who are not in the labor force has been accelerating quite dramatically since since October of 2024. So these are people who are neither employed or filed unemployment, right? They're completely out of the labor force. And so that brings us to the second division, right? So there's the people not in the labor force. If you scroll down here, you have how that's divided up, which is people they don't have a job and they're not even looking for jobs, right? So those are other people who are not in the labor force. And then you have what's called the marginally attached to the labor force. Now, these are people who do want a job, but for whatever reason, they are unable to even just be unemployed, right? So these are people who are available to work and are searching, but have not been able to find jobs over the past month, right? Or it's in between the last 12 months and as well as the last month, right? So if somebody was unemployed for within 4 weeks, that's counted as the unemployed. All right. So all this to say is that there has been a large acceleration in the amount of people who want a job but have been marginally detached and are discouraged workers, right? So this large acceleration here means that people are moving from the unemployment box to the not in the labor force box. And so if people are moving from unemployed to not in the labor force, that is actually a sign of not good health in the labor market, right? But because the unemployed people are going to not in the labor force, that actually will show a decrease in the unemployment rate. And so, if that number continues to rise, you could still have a weakening labor force, even though the unemployment rate could remain, where it's at. And then ultimately, what will happen is a lot of people from the employed part will start to fill up the unemployed box, and then that will then accelerate the unemployment rate there. Now, when talking about the unemployment rate, usually people think of this number here, which is currently it's at 4.1%. This is what's called U3. But really what you want to look at is what's called the U6, which includes other people such as marginally attached, as well as those who are in the gig economy, right? Because the regular unemployment rate, it doesn't take into consideration people who just don't even file unemployment claims. And then they just do something like Uber or DoorDash or one of these other, gig, types of jobs because one, it's flexible. Two, it's pretty inconvenient to go on the government website and file for unemployment claims. And then if you do qualify for it, they don't even give you that much, right? I think it's like, depending on where your income level is, if you lose a larger paying job, I think you get a little bit more, but it's not much. It's like the difference between getting like $200 a week versus $300 a week, right? It's really unlivable. So most people aren't even dealing with filing for unemployment claims, and they're just going right to driving for Uber or doing DoorDash while they are applying for other jobs or whatever. And so when taking a look at the headline unemployment rate, that is artificially suppressed. You want to be taking a look at U6, which that unemployment rate is at 7.7%, and it does continue to trend higher. It hasn't had a spike like what we saw back in March of 2000 or in December of 2007, or obviously during the pandemic. But if this goes up to anywhere north of 7.5%, 8%, then that could be the start of a much larger trend in the employment numbers. All right, so a little bit of education there in terms of the different employment numbers that we get. But really, what you need to pay attention to is U6 unemployment. Right, all that to say, look at U6 unemployment, as well as the household survey data. And then if you want to look at the establishment survey, we're going to be paying attention to private job growth, not so much the headline non-farm payrolls, because again, that includes government jobs, which as we saw was skewed by the rise in state government employees. And that continues to accelerate. All right, and so as of right now, this week, on Friday, we have the August 1st tariff deadline. After that, there's going to be no extensions. And so we've seen actually a push for some deals being made. One with the EU this week, which the market definitely enjoyed. So there's now a 15% set tariff on most goods coming from the Eurozone area. And so we could see some more trade deals coming in during the last few days here, last minute before the August 1st deadline. But, we'll see what happens from there. Maybe they do even extend it. Who knows, right? But yeah, so the August 1st deadline is coming up on Friday. But again, looking at the market trends, which again, all that macro data is important, but really, we want to pay attention to the actual trends in the financial markets here. And so, as we get more data this week, as well as we have a large report in terms of earnings, there could be a rise in volatility just given how low the VIX is and all the different pieces of information that we are going to be receiving this week. But what I'm also seeing is that rates still remain pretty high. 4.4% on the 10-year U.S. government bond yield. 3.9, basically 2% on the U.S. government bond or 2-year U.S. government bond yield. So rates still remain higher. If we take a look at the 13-week Treasury bill, you can see that this is remaining elevated, and it's actually risen, over the past basically 2 months. Which the reason why I look at this here is because this was able to front run the rate cuts from last year. You started to see this decline all the way in mid-August, right? So basically, an entire month before they actually cut rates by 50 basis points, the IRXP was dropping, and so you had a pretty early warning sign by this indicator here that they were going to cut rates. If you zoom out, if you go back, on a weekly time frame, you can see that this pretty much tracks and does a really good job with early signals for interest rates here. And so, yeah, we're not seeing any type of signal from this in terms of them cutting anytime soon. In fact, this has trended up a little bit, right? I'm not saying that this is saying that that they're going to raise interest rates, but they're going to remain paused still. And I'm firmly in the camp that I don't think that they're going to cut rates at all this year, which I know that that's not what the market is pricing in. But why would they? If inflation is remaining sticky, if there's no real sign of implosion in the employment market, and it's kind of just treading along the way that it is, why would they cut rates if everything is fine, right? It's that double-edged sword. And with the current political climate that we're seeing right now, right, we had that whole theatrical move by Trump visiting the Fed building last week with Jerome Powell, like at some construction site. It was pretty funny seeing them both with hard hats on. But yeah, I mean, Trump is definitely doing a really good job with making Powell feel like he really shouldn't cut rates. Because again, the Fed, the only thing that they really care about at the end of their day, at the end of the day, is their reputation, and so and their credibility. And so part of that is being independent of the government. And if they can do something to, continue that narrative, that's what they're going to do. And so, if Trump keeps antagonizing Powell, that's just further, digging him into a hole where they're not going to cut rates. So, yeah, we'll see how that works. I don't think he's going to get fired. I think they're just going to let him continue with his job until his term is up in May of 2026. All right. And then one of the measures that I like to use for the inflation rate, which is the 5-year break-even inflation rate, that has been rising over the past several weeks as well. And so, yeah, I mean, there's no real signals to me that's, showing that there's going to be any type of significant improvement in disinflation, right? So that's pretty much what I'm seeing here this week. For those who are joining here on stream on social medias, on YouTube as well as TikTok and Instagram, typically the way that these Sunday macro wrap-ups work is during the first 30 minutes of the hour-long session is streamed, and then the last 30 minutes is in our macro investing community. And so if you guys would like to join us for the second half of this, we're going to go ahead and close it out here on the live stream. But if you want to check out and join us offline, you can go to our website, macro-optics.com, and check out the 7-day free trial of our macro investing community. But we appreciate those who had joined us here live. For those who are on the Zoom call, stick around. Don't go anywhere just yet. I'm going to go ahead and end the stream. So we'll say bye to YouTube, Instagram, and TikTok. Bye, everyone. Have a great week.